Home Bank shares, ticker HOMB. Second quarter 2026 earnings are out, and they completely beat consensus on the top and bottom lines.
Yeah, the stock reacted immediately. It's up in early trading, and for good reason.
Right, because the headline numbers are just wild. Revenue is surging, EPS beat the street, and though they kept forward guidance pretty close to the vest, the actual Q2 net income came in at $119.3 million.
Which is solid, but the adjusted net income is the real story here. It hit a company record $128.1 million.
Yeah, an 8.4% jump from just 3 months ago.
Exactly.
And if we look at the core segments, net interest income after credit loss expense printed at $236.4 million. Plus, non-interest income just surged to $53.5 million. So if you're listening to this, imagine buying a massive new business, right? You pay millions of dollars in upfront closing costs.
Which hurts the bottom line initially.
Right, exactly. You pay those costs, but then you wake up the next morning and your core profit margins are somehow breaking company records.
It's supposed to be mathematically impossible in the banking world.
It really is. But this regional bank in Arkansas just did exactly that.
Yeah, and that's the real narrative buried inside these headline numbers today. The mission for our deep dive is to, really analyze the core driver behind this specific quarter.
The Mountain Commerce acquisition.
Exactly, the completion of that deal. We need to dissect how home bank shares managed to bolt this entirely new bank onto their existing infrastructure.
Without stalling their own engine in the process.
Right. We're going to look at how it altered their margins, test if their operating efficiency held up, and ultimately figure out if they sacrificed their own shareholders' equity to pull this off.
Well, before we go any further into the weeds, I think we need to address those GAAP versus non-GAAP numbers.
Oh, absolutely.
Because that's a massive stumbling block for a lot of retail investors. Let's translate this into plain English.
Sure.
The strict official accounting rules GAAP, or generally accepted accounting principles, show one reality, but the company's quote-unquote adjusted numbers show this massive record profit.
Right, which always makes people suspicious.
Yeah, exactly. But think about it like buying a highly profitable rental property. The $12.7 million in merger-related expenses that drag down the official GAAP net income, that is basically you paying the upfront closing costs. You're paying the inspectors, the lawyers, for your new rental property.
Yeah, it heavily penalizes your profit on paper for that very first month.
Exactly.
And I think that framing clarifies the accounting reality perfectly. Because when you look at an acquisition in the banking sector, there is just an immense amount of initial friction.
Oh, tons.
You've got system migrations, massive legal fees, severance packages for redundant executives.
Right.
All of that is baked into that $12.7 million upfront hit. But when you strip away that one-time closing cost,
just to see the true ongoing earning power of the bank.
exactly, the non-GAAP or adjusted number, it hit that $128.1 million record. It indicates that the underlying engine of the combined entity really didn't skip a beat.
The new asset is already cash flowing beautifully.
Yeah, generating substantial cash right out of the gate.
So let's talk about that underlying engine, which brings us to the net interest income, or NII.
The bread and butter.
Right. For any bank, this is the absolute core of the business. Net interest income after credit loss expense rose to $236.4 million.
Which is a very solid 5.8% increase from the first quarter.
It is. Now, the sources attribute this growth to two main things: continued growth in earning assets and favorable net interest margin performance.
Right.
But okay, I have to put my skeptic hat on for a second here.
Go for it.
They just bought Mountain Commerce. They just bought a massive pile of new loans.
Yeah.
So of course the revenue went up. If I just buy someone else's wallet, I have more money, right?
Well,
Is this 5.8% bump actually impressive, or is it just the mechanical result of adding two balance sheets together?
see, that buying a wallet analogy is exactly where a lot of retail investors misinterpret bank acquisitions.
Really? How so?
Because it completely ignores the liability side of the equation. If you buy a wallet full of cash, but it also comes with a credit card bill that actually exceeds the cash.
Oh, then you're actually poorer.
Exactly. In banking, loans are assets because they pay you interest, but deposits are liabilities.
Right, because the bank actually owes that deposited money back to the customer.
Correct.
Yeah.
And the bank has to pay rent on that money, basically in the form of interest.
Got it.
So when Home Bank Shares bought Mountain Commerce, yes, they acquired revenue-generating loans, but they also acquired a mountain of deposits that they now have to pay interest on.
Okay.
This is exactly why management specifically called out favorable net interest margin performance as the co-driver. The margin is the key metric here.
Okay, so explain how the margin works in this context for everyone listening.
Think of a bank like a massive water reservoir.
Okay.
Deposits are the water flowing in from the local river. You have to pay a fee to the town to take that water in. Loans are the water you then pump out to local farms. And you charge the farmers a higher fee for the pressure and the delivery of that water.
Makes sense.
The bank's profit is the pressure differential between what flows in and what flows out.
Right. So if Home Bank Shares was just buying Mountain Commerce's loans, but they were forced to pay exorbitant rates to keep the depositors from leaving,
The overall reservoir pressure would drop.
the margin would compress.
Exactly. So the fact that the sources highlight favorable margin performance means the core pricing dynamics are working in their favor. They are wringing more profitability out of every single dollar they lend out.
But how are they managing that in the 2026 macro environment? I mean, depositors aren't accepting 0% interest on their savings accounts anymore.
Definitely not.
People are actively hunting for high yields. So how does a regional bank keep that deposit water flowing in without paying so much that it destroys their reservoir pressure?
It requires intense discipline in how they price their products. A lot of banks get desperate. They start relying on what we call hot money, institutional certificates of deposit or broker deposits.
The stuff that demands top-tier interest rates.
Right. It solves the water shortage temporarily, but it completely ruins the profit margin.
Gotcha.
So, home bank shares demonstrating favorable margin performance during an acquisition implies they're retaining sticky, relationship-based core deposits.
Customers who keep their money there because, their business payroll is there.
Well, their mortgage is there.
Yeah.
Exactly. Not just because they're chasing an extra 0.5% of yield down the street.
Right. Relying purely on that loan reservoir can be dangerous, though.
Oh, absolutely.
I mean, if the Federal Reserve suddenly slashes rates or hikes them further, that pressure differential can evaporate overnight.
It can.
Which explains why the next data point in this earnings report is arguably the most critical for the bank's long-term stability. Non-interest income surged to $53.5 million.
Yeah, that's huge.
That is a massive 24.9% increase compared to just 3 months prior. It vastly outpaces the 5.8% growth we saw in the core lending engine.
And a sequential quarter-over-quarter jump of nearly 25% in non-interest income, that fundamentally alters the revenue mix for the entire institution.
Right. It provides an entirely separate engine that just isn't reliant on interest rates.
Exactly.
Let's frame this for you guys listening using a big box retailer. The core lending growth, the NII we just talked about, is like the retailer selling 5% more televisions this quarter.
Which is fantastic. It's what they do.
Right. But this surge in non-interest income, that is like the retailer suddenly making an absolute killing on extended warranties, HDMI cables, and in-home installation services right at the register. It's high-margin revenue that diversifies their income stream away from just selling the TVs.
That tracks perfectly.
Right.
Because non-interest income in banking is entirely service and fee-based.
Right.
The sources point to 3 specific drivers for this 24.9% surge. First, they cite higher other service charges and fees. Second, a favorable fair value adjustment on marketable securities. And third, general growth in other income, supplemented by adding that Mountain Commerce customer base.
Okay, wait, I need to stop you at that second one.
With the fair value adjustment.
Yeah, favorable fair value adjustment on marketable securities. Because to a retail investor reading an earnings report, that just sounds like pure Wall Street accounting magic.
It does.
How is changing the value of a security considered income?
Well, it is a controversial accounting quirk,
Mm.
but it's vital to understand the mechanics behind it.
Okay, lay it on us.
Banks hold large portfolios of securities, like government bonds, just to ensure they have liquid assets. The open market value of those bonds fluctuates every single day based on macroeconomic conditions.
Sure.
So mark-to-market accounting rules actually require banks to adjust the value of those assets on their balance sheet to reflect what they could sell them for today.
Right.
A favorable fair value adjustment just means the market value of the bonds they hold went up during the quarter, and they are literally required to recognize that paper gain on the income statement.
But wait, if it's a paper gain, that means it's not actual cash coming in the door from a customer?
Correct.
Why should you, as an investor, care about a spreadsheet adjustment that doesn't generate real cash flow?
Honestly, On its own, you shouldn't put much weight on it.
Really?
Yeah. If paper gains were the only reason their revenue went up, it would be a massive red flag.
Right, because the market can take that paper gain away just as quickly next quarter.
Exactly. However, that is why the other drivers, the higher service charges and the general fee growth, are so critical to validate this specific quarter.
Ah, I see. So the wealth management fees, the treasury management services for commercial clients, the standard account fees from all those newly acquired Mountain Commerce customers,
Yes.
those are the HDMI cables. That is actual recurring cash hitting the bank's accounts.
You got it. When you add Mountain Commerce into the ecosystem, you have thousands of new accounts to offer wealth management to, right?
Right.
You have more transactional volume to process. That creates a highly resilient overall revenue profile because this specific income stream acts as a shock absorber.
Because if loan demand dries up tomorrow, these fee-based services just keep generating cash.
Exactly.
Which brings us to the ultimate scorecard for how all these different revenue streams are actually functioning together.
PPNR.
Right. We've got loan interest pumping and we have fee income surging. But for the retail investor, the real question is how efficiently this revenue filters down the income statement before management starts making educated guesses about the future. And that is where PPNR comes into play. Pre-tax, pre-provision net revenue.
Yeah, PPNR is basically the absolute gold standard metric for bank analysts.
Because it strips out the noise.
Exactly. It strips out the tax rate, which, fluctuates for structural reasons completely out of management's control. But more importantly, it strips out the provision for credit losses.
Let's define that provision for a second, because it's not actual lost money, right?
Not yet, no. The provision for credit losses is essentially a dial that management turns based on their view of the macroeconomic weather.
Okay.
If they look out at the economy and see a recession looming, or say they think commercial real estate is getting shaky.
Which everyone has been talking about lately.
Right. They will preemptively take a chunk of their revenue and lock it in a vault to cover future loan defaults.
So they take the hit on the income statement today, even if not a single customer has actually defaulted yet?
Yes. It's an educated guess about future pain.
Wow.
By removing that guess and by removing taxes, PPNR gives you the purest unfiltered look at the bank's core operating engine right now. Today.
Are the day-to-day revenues growing faster than the day-to-day expenses?
Exactly. That is what PPNR answers.
And the numbers for home bank shares are super significant here. The baseline PPNR hit $159.6 million for Q2. But when they adjust out that $12.7 million Mountain Commerce merger expense and, a few other minor items, their adjusted PPNR hit a company record $171.2 million.
Which is a sharp jump from just $152.7 million 3 months prior.
It is, but I'm putting my skeptic hat back on.
I love the skeptic hat.
Well, as a retail investor, whenever I see a company rely heavily on adjusted non-GAAP metrics, alarm bells just go off.
Sure.
I mean, we see tech companies constantly adjust away their stock-based compensation just to pretend they are profitable.
Oh, all the time.
So how do we know home bank shares isn't just sweeping terrible operating decisions under the rug of the word adjusted?
Look, it is completely healthy to view adjusted metrics with suspicion.
Yeah.
You always should.
Right.
The difference here is the nature of the expense being adjusted away.
Mm.
Like you said, tech companies have to pay their employees with stock every single year.
Yeah.
It's an ongoing recurring cost of doing business. But the $12.7 million in merger expenses for Mountain Commerce is genuinely a one-time event. They are not going to buy Mountain Commerce again next quarter.
That's true. Give me a concrete example, though, of a merger cost that actually just vanishes.
Consider the software infrastructure.
Okay.
When you buy a bank, they're usually running their entire operation on a completely different core processing system. Right. So to integrate them, you have to hire outside consultants, you have to pay early termination fees on software licenses, and you have to migrate 1 million customer data points over a single weekend.
Just the logistical nightmare.
Exactly. And that alone can cost millions of dollars. But once the migration is done on Monday morning, that expense ceases to exist forever.
Wow, okay.
If you leave that cost in the PPNR calculation, it distorts reality. It makes it look like the bank's daily operations suddenly became wildly inefficient.
So they are basically saying, here is what our normal banking business generated, and here is the one-time receipt for the bank we just bought.
That is the perfect way to contextualize it.
Awesome.
The fact that the adjusted PPNR jumped to a record $171.2 million proves that the core operations, stripped of all that one-time M&A friction, are genuinely expanding their baseline profitability.
So we've established record revenues and record operating cash flow.
Yes.
But there is a final boss to beat in bank earnings, and that is the balance sheet.
The big one.
For you as an investor, record cash flow is a great headline. But the ultimate question is whether management destroyed balance sheet value to fund this acquisition. Because you can buy all the revenue in the world if you're willing to dilute your shareholders into oblivion to afford it.
And sadly, the M&A graveyard is just littered with banks that failed this exact test.
Right.
A management team gets obsessed with growing the size of their empire. They pay a massive premium to acquire a competitor. They issue millions of new shares to fund the purchase.
And while the total revenue goes up, the actual value of the underlying equity per share plummets.
Exactly.
But that is the complete opposite of what happened here.
It is.
Let's look at the book value. Book value per share actually increased from $22.15 in Q1 to $22.68 at the end of Q2. But even more critically, tangible book value per share, which strips out all the intangible goodwill, rose from $14.87 to $15.32.
Yeah, we definitely need to unpack this, starting with goodwill.
Yes. What is goodwill in an acquisition, and why is it a threat to the balance sheet?
Let's say you want to buy a local coffee shop.
Okay, I love coffee.
Right. The espresso machines, the furniture, and the cash in the register are worth exactly $300,000.
Okay.
But the shop has a great brand and you really, really want it. So you agree to pay the owner $400,000.
Got it.
That extra $100,000 you paid over the fair value of the hard assets, that is recorded on your balance sheet as goodwill.
But goodwill isn't a tangible asset. Like, I can't sell the coffee shop's good vibes to pay off a bank loan.
Exactly. Goodwill is essentially accounting deadweight.
Okay.
Tangible book value per share strips that deadweight out.
Mm.
It measures only the hard, cold, sellable assets of the bank divided by the number of shares.
Right. When a bank buys another bank, they almost always pay a premium, which floods their balance sheet with goodwill. This typically causes their tangible book value per share to drop significantly for a year or two until they can earn back the premium through profits.
Okay, so to give everyone an analogy for what home bank shares accomplished here, growing your tangible book value during the exact same quarter you close an acquisition is like eating a massive 5,000-calorie Thanksgiving dinner. You are digesting an entire other bank and its goodwill premium.
Right.
But somehow you step on the scale the very next morning and you have less fat, more muscle, and you're in vastly better physical shape than you were the day before.
That analogy captures the extreme rarity of this outcome perfectly.
It's wild.
To post growth in tangible book value from $14.87 to $15.32 in the immediate aftermath of a deal. It proves that their organic profit engine was running so incredibly hot during the quarter, it instantly absorbed the entire acquisition premium.
And still added hard value to the baseline. Exactly. They didn't just buy growth for the sake of empire building. They bought highly profitable growth that immediately added cash to the bottom line.
Without sacrificing the integrity of the balance sheet.
Exactly.
And, I want to point out the geographic reality of this performance because it completely shatters a major Wall Street stereotype.
Oh, I know where you're going with this.
Yeah. The corporate headquarters listed on this earnings report is 719 Harkrider Street, Conway, Arkansas. This is not a Wall Street mega bank with a $1 trillion derivatives book and an army of quants in Manhattan.
No, it's not.
It is a regional player quietly executing complex acquisitions, expanding margins in a completely hostile environment, and driving tangible shareholder value right from the heartland.
Which highlights a crucial dynamic for investors.
Yeah.
Capital allocation discipline is not geographic.
Nope.
The operational excellence required to pull off an accretive deal that actually grows tangible book value on day one, that speaks to a management team that is intensely focused on per-share profitability rather than just aggregate size.
So let's synthesize everything we have uncovered in our deep dive today.
Let's do it.
HOMB Bank shares successfully digested Mountain Commerce. They ate the $12.7 million friction cost upfront. And despite that headwind, their core lending engine expanded its margins in a really difficult rate environment. Their non-interest fee business surged by nearly 25%, providing massive revenue diversification. And they managed to organically grow their tangible book value per share, essentially getting paid to get bigger. It is a remarkably clean quarter once you look through the noise of the merger accounting.
It really serves as a masterclass in how regional bank consolidation is supposed to function. It was accretive, efficient, and immediately complementary to the core operating metrics of the acquirer.
Which leaves you with a deeply provocative thought to ponder as you evaluate your own portfolio.
Okay?
If a regional bank in Conway, Arkansas can integrate a major competitor this flawlessly and actually expand their profit margins in the turbulent, high-rate environment of
Oh,
2026,
yeah.
what does that signal about the broader ecosystem?
That's the real question.
Are we currently entering a golden age of regional bank consolidation, where the highly disciplined, well-capitalized predators systematically eat the weak, subscale
It's
banks?
very possible.
It is definitely a dynamic you have to watch closely as the rest of the year unfolds. Make sure you follow the show for your daily dose of tight, no-nonsense earnings coverage. See you on the next Deep Dive.